And we are now live here on our YouTube channel. It's our daily show we call the Halftime Report, where we go through these markets one step at a time, top-down analysis style, breaking down the news, breaking down the price action, looking at the charts that matter, giving you guys some analysis and some insight in what's happening out there from the coaches at Tackle Trading so you can better run your daily routine. And another reason we do it is just to get the community together and talk markets on a daily basis, and always love doing that. And the official hashtag, as we always get started with our conversation, is hashtag Team Tackle right in the chat. Let's light that up the way that we always do. To my veterans, to beginners out there, if you are just finding tackle trading, welcome. You know, we got an amazing community of traders. We get together, we connect, we learn together, we trade together, and we succeed together. Make sure you click that subscribe button, click the bell, and come back and join us whenever we go live on our YouTube channel. And by the way, we got two live shows here today. I got the Halftime Report, and then tonight, Maddie, I don't know if you know this. I think you do.
I think I do. I think so.
The Cisco
arms
kid.
Out. The
yes,
arms
let's
out.
do it.
Arms out.
I've got a shot here tonight. All right. I'm finally going to participate in the Trade Masters program, and I get to have some fun the way the coaches always get to have some fun. I am very much excited about it. I am the challenger tonight to the de facto winner of Coach Greg, by the way. Now, here, I got to get a clarifying question. Like, you play referee for me for a second, okay? Greg didn't win last week.
No, he didn't, did he?
He did not. Tyler won, but Tyler's on vacation.
Listen, Tyler, it's like a boxing situation. When somebody retires, the governing body has to announce a new champion. And if Tyler can't make it because he decides to go on his 5th vacation in the last 5 weeks, that's fine. He gets his belt taken away from him. Greg retains the belt, and you're going up against the champion. That's Tyler's fault for going up. Well,
all right.
I don't think Tyler would be like, that's my fault. That's like, I'm enjoying golf.
I'm on vacation, dude. Yeah, I don't care. My fault, my gain, I guess.
We can have fun at his. We can have fun at his expense, though.
Yeah, no. And by the way, Tyler is gone today. We usually have him on Wednesday show, but he's on his 5th vacation in 5 weeks, like Matt said.
We
living the dream.
Maybe we're a little jealous of that 5th vacation.
Tyler, if you're out there and you're watching the show, enjoy your time off, my friend, as you always should. Spend some time with family. Let's get down to business here, Matt. We got a lot to do. By the way, we did finally get the space flight from William Shatner there this morning. I don't know. I know that
Kirk in space. There you go, buddy. The headline writes itself. Congratulations to Amazon Blue Origin. And did they land?
He did. Yes.
They landed. Good for them.
Believe
Oldest
they got back
man
safely.
in space. That is an amazing story, truly. I do love Star Trek, but even if you don't love Star Trek, 90-year-old dude goes into outer space, oldest man in history to go into outer space. Man, what a cool story.
It's very cool, you know, and God bless him, and great for him that he has the ambition, the energy, and all those things to want to go out and do that and still be a public figure and share his life with us. So very cool, William Shatner. Congratulations on that. Outside of that, there's no market relevance to it. So let's get down to market analysis.
Well, we do have CPI that came in at 5.4% year over year. We do have that.
That might be a little bit more
important
as to what's happening in the economy right now.
We furthered the transitory language here. We're just expanding that out. I just have one question, Tim. I just have one question.
All right.
One question. I would like the central bank to define transitory from a time frame perspective.
Sure.
That's all I'm asking.
Yeah.
Okay. Because we have now been using the language of transitory for over a year now. Okay. How long is transitory? That's the one question I want Mr. J. Powell, the chieftain of our overlords, to answer. What is the time frame for transitory, so that I know when that date is? I need to blast you for being wrong on it.
Can I put on my swag hat right now? Do you know what swag is?
Yeah.
Scientific wild ass guess. I'm going to try right now. Okay.
That's scientific, huh?
Yeah. I think what they would actually tell you if they were giving you a direct answer, trying to answer it just as truthfully as they could, is they would say, until we get through the period where COVID disrupted economic, kind of reality. So whatever that is, they might give it a year, 2 years, 3 years, those types of things.
Never. Okay.
Never. Yes,
never.
I know.
Okay.
What they what they actually mean, though, in my opinion, is
when the narrative shifts.
Whenever the narrative changes.
Yep.
Yes. Whenever we want to paint a different picture, we'll tell you it's no longer transitory, and we'll tell you it's good for you instead.
Yeah, this is true. This is how they do work. This is how they do work. See, this is how it's going to work, Team Tackle. We're dealing with 5.4% annualized inflation at this point, right?
Mm-hmm.
That inflation is most likely here to stay for a certain amount of time, maybe coming into summer 2022 as we start to see some supply chain disruptions start to, fix themselves a little bit, right?
Mm-hmm.
Over time, we get post-pandemic, economies open up, supply chains open up. That will have a tendency to fix a certain degree of the inflationary situation. Now, but what about the rest of all the metrics that impact inflation? Okay. And that's where I come in and why I feel the Fed is wrong on the transitory language.
Mm-hmm.
The transitory language is literally around supply chains, right?
Mm-hmm.
Because the Fed doesn't want to point to the $120 billion that they're pumping into the market on a monthly basis. They don't want to point to the over $4.3 trillion in additional Fed balance sheet that we have pumped into the market over the last 18 months. They don't want to point to that. They certainly don't want to point to the government putting out trillions upon trillions upon trillions of dollars that really has been tried and used already.
Mm-hmm.
But my point is very simple. Even if the transitory language associated to the supply chain disruption, even if they're right on that, they still are going to be left with 3 to 4% inflation based on all the other metrics.
Correct.
And so transitory will happen because the supply chain disruptions will be fixed over time. But what we're left with is still a inflationary environment that offsets whatever wage increases at a rate that is much higher than at any point over the last 40 years. That is still very, very concerning from an inflationary perspective. And so I get the Fed. I mean, they want everybody to buy hook, line, and sinker every single aspect of this transitory language because they don't want it to be pointed at their doorstep about the situations and the impacts they have had a hand in. But I've never bought into this transitory language, and I certainly don't buy into it today.
Well, here we are at the fourth quarter of 2021. They've been talking transitory for quite some time now, even just kind of dismissing the data. We now, even just starting the quarter, Matt, we're starting to see companies continue to cite higher price pressure as a problem.
Delta Airlines in their earnings report here today.
Absolutely. And even those supply chain bottlenecks that you just made a statement, I believe, that they will solve themselves over time. We don't know exactly when that is. I know Jamie Dimon said yesterday he thinks 2022, they'll all be cleared out. Hopefully, it doesn't mean prices are coming down.
What else did Jamie Dimon say in his little letter, not letter, but his announcement today? He said, yes, I fully expect that in a year from now, this is Jamie Dimon today, in a year from now, we will not be speaking about supply chain disruptions. In the same, what seemingly the same sentence though, he also stated that inflation can persist much longer than what people are discussing right now. Put two and two together, supply chain disruption does not fix the inflationary pressure.
And that's the important point right now. We saw even more data here today. The CPI report came out. We're going to get the PPI report tomorrow. Year over year was up 5.4%. All these headline numbers are concerning. Fed keeps dismissing it. We'll hear from them actually today with their policy statement from the meeting minutes from 3 weeks ago. They're not going to update us with any new information.
The Fed's asleep at the wheel. Jay Powell is 100% asleep at the wheel. He's trying to buy time. You do not, and this is a rule that we have to understand with inflation. You do not try to buy time to fix inflation. You raise interest rates to fix inflation.
You
period, end of sentence.
Volcker thing. Yeah.
Period, end of sentence. Yeah. You have courage of your conviction. That's what you do. But again, buying time while you continually pump more money into the market doesn't fix inflation.
No.
It adds to it. It's fuel to the fire. But again, I don't want to get off on a tirade today about inflation, but the CPI report certainly did come in.
Not today, but we'll keep talking about it because we'll keep speaking truth out there, Matt. We got to keep talking about it as it happens because inflation is a huge problem, a huge concern, and it's out there. It's out there, no doubt about it. All right, let's get down to business here today. By the way, we got some corporate earnings to round up a little bit later in the show. JP Morgan, BlackRock Financial, Delta Airlines, Infosys, systems. Some big names that did finally come out and give us some data and some report. I know Coach Matt has dug into the reports. We'll look at the price response as well during stock talk. And by the way, earnings tomorrow. Bank of America, Citigroup, Morgan Stanley, Taiwan Semi. It does not slow down from here, guys. We're going to continue to get reports as we go. But let's start with the technical response.
Well, can I ask you a question?
Yeah.
We've had a few earnings reports in the last couple of weeks, correct?
Yeah, a couple that have come out.
Doesn't it feel like when JP comes out, this is when it really starts?
All that stuff feels like pregame.
Yeah.
This feels like kickoff. That's exactly the way I feel.
Yeah. This BlackRock, JP Morgan, Delta, big names, major players in their industry. You're talking about one of the biggest banks out there. You're talking about one of the juggernaut of juggernauts, asset management firm BlackRock, and obviously the leader of the pack in the big three between Delta, American, and United, Delta reporting. So I kind of feel like, if we want to point to a start of earnings season, I think this is the start, JP Morgan.
Yeah, I think it is the kickoff day. There's no question in my head, because then it's not only just about these three companies, because if they reported 2 weeks ago, we might have the same similar commentary. It's about how
the rash of other ones come immediately
after. The domino effect. Yeah. That's exactly right. We start getting it hot and heavy.
If you'll remember, and again, this might just be curious for a few people that have been trading for a long time, but if you remember, earnings season typically started back when we started trading with Alcoa.
Correct.
Right. That we're kind of old, bro. But with Alcoa, and now Alcoa is not even a Dow 30 component, but then it's like, well, if it's not Alcoa, maybe it's Nike. I think we should just come in and just accept the truth that when JP announces this is the official start.
JP Morgan starts the earnings season. I'm calling it today. I'm with Coach Matt. We're making it official from now on. We are calling that kickoff, and we did get kickoff here today. I want to look at those numbers here in just a minute. But like you said something to me today, I thought was very, very important. I think out there, if you're watching the show, I want to share a little bit of wisdom I got from my brother this morning. You always start with the price action responses. Now, I kind of already know your relative need and your reliance on charting, because charting is so important, so comfortable for you to kind of get that data first. But you don't go to the news first. You don't go to your news sources. You start with the chart, and then you go to the news afterwards to try to backfill. Is that correct?
It's different in bullish condition versus volatile versus bearish conditions. Like when you're looking at a trend like this, Tim, and you're just dealing with a very consistent trend, I typically will check the news first, because I'll just kind of get a lay of the land, and then I will come in and do my detailed technical analysis. But when it comes to bear markets, man, those hot takes out there, number one, they get thick real fast. Yeah. I mean, they get out there real fast. It becomes a very opinionated market in bearish conditions, a very opinionated market. And I feel like the truth is being told. And I feel like a lot of out there is just, again, opinion. And I'm not saying it's mistruths or whatever, but it might not be what you're looking for, and it might not be your take. I feel like the general truth of the market is told from a technical condition perspective. And it's the technicals that I do find that tell the truth of what is transpiring in the market far more than what the news does. I don't, and it's not that I don't trust the news, but I don't trust the news. I want to know what is out there, what is in the information, what is in the lexicon, just like everybody else. But the truth of the market, in my opinion, is from a technical condition of how the market responds to the news, how the market prices in news, and especially in volatile, bearish, reversal conditions where I feel like the news media gets extremely opinionated around things, to the point where you start to see little micro arguments happening between many companies and organizations about whether we're bullish, whether we're bearish, or the value arguments. And don't get me wrong, I love participating in those things the same way everybody else. I'm a very opinionated individual myself, so I'm not casting aspersion or anything on that. But what I just feel more comfortable with is the technical and the price response to the market, far more than what somebody's interpretation of, say, the CPI report is.
100%. And part of the reason why that is the case, somebody who digests as much news as I do, I will give the audience out there a little context here. It's because a lot of the themes that you see in headlines, Matt, They're just trying to drive traffic, like we all know. But even more than that, it's lazy analysis, because what happens is it builds from 3 weeks ago or 2 months ago, and they just don't update the narratives until somebody else updates them for them. And so that's why you need that second interpretation of the news. You can't just look at the headlines and go with it. You got to focus on price action first. I think it's a very good lesson. Absolutely.
Well, and you take that, for example, just look at it today. Yesterday we were talking about the market, forming a little bit of a support level. There's been just a gluttony of news coming into us today from Delta, BlackRock, Jamie Dimon talking about every single topic. You want to talk about people that love to talk? Two of them had earnings reports today, Larry Fink and Jamie Dimon. They love to talk. And so they bring a lot of media, and people love interviewing those two individuals because they're very open about their opinions. And I 100% respect that. And so there's a lot of news coming out in the day today. But when you look at this from a price action perspective, what do you see? You see support levels that we've discussed in recent history start to form. You see a support level yesterday at 43.20. You see one again at 43.20. Now, why this 43.20 level is important to me is it really doesn't have a lot of history at 43.20, a little bit over here, but not a lot of history. It was the low price of yesterday, and why I kind of feel it's important. You see this cash open, and these levels, they just become important over time. But you see the cash open about right here, about that 6:30 time frame right there. Okay, so let's come back down to a little bit of 15-minute chart. So you had, from the CPI report, you had some pressure being put on the market, coming down, 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 down. Right here, though, at 6:30, you see that drop in price. You see that coming down pretty aggressively on the cash open. But where does it find support? It finds support exactly at the exact same level as it did yesterday, 43.20. That tells me a little bit more truth to the market of where the buyers are coming in, a little bit more than what we're reading in terms of headline news and what people are reading in terms of articles and the information that's coming out on social media. That tells me the truth of the market, that there were buyers that came in at 43.20 and they came in fairly aggressively. Now I feel like you do have a pretty important range developing here in the S&P, similar to what we had last week as well. But when you're looking at this, you see that support level of 43.20. We're still looking at this 43.60 to 43.70 barrier. That level, the level we discussed yesterday, I still feel that level is very, very important. And we've been talking about that, the potential reversal analysis that is happening in the broad market conditions. And yesterday we were looking at this from an identification of support, and we faded a little bit as we broke intraday support yesterday, and we found that foundation towards the low price as well. So we came back towards the lows of yesterday. We dinged it again here today. Now you give that a couple more days. And again, there's a lot of earnings in the next couple days. There's going to be a lot, there could be some volatility to the marketplace, but you give this a couple more days. And if we get a little bit more follow through, all of a sudden that creates a pivot point. It's not yet. Pivots take time. But it's the potential of a pivot creation. When you start to see the foundation from an intraday perspective, you start to see that support start building on a daily. All you're waiting for is that upward movement in price. And I still come back down to the 30-minute chart, and I'm looking at this 43.60. I'm really looking at 43.65. That's kind of the number I have in my head. Once you get above 43.65, you can definitely see those day traders taking a hold of the price action. 43.70 is right where that downward moving 20-period moving average is. And we have yet, keep an eye on this, we have yet, in this bearish downtrend that we've been dealing with over the course of the last 4 or 5 weeks in the market, we have yet to have a close above the 20-period moving average. We've tested it, but we have yet to have a close there. You build support from 43.20, you see that as an increasing support level. There is an opportunity here in the market. We just got to give it a little bit of time to flush out some of these earnings reports and see a little bit of resistance levels get broken here.
Well, and one bad report, by the way, is not going to make the market drop precipitously or break.
You had one. You You had two of them today, Delta and JP.
Mm-hmm.
So even with Delta and JP coming out as on a negative handle, and we'll go through those reports here in a second, not massive depreciation of price action, but they did have a negative print here today on their actual price action. Still, market trying to find support here.
Yeah, and by the way, those levels that you identified, we've got intraday levels, we've got those daily levels. Just I want you to confirm one thing for me, that 4430, because 4365 maps out perfectly for me, is really obvious to me. 4430, the only question I have around that, and by the way, 4260 on the bottom part of that overall channel on the daily chart.
4260 is ultimate.
All those map out very, very clean to me. And 4430 looks very significant. There's just a little tiny pivot point about 2-3 weeks ago. Is that going to play into analysis for you as well? Is the 4430 clearing the 50? That's what you're watching for. What do you think there in that 43 or 4455 to 60 zone as well?
Obviously, I'm going to be looking at the 50-day moving average the same way everybody else is. But before we get to that, you got to first claim that 4360, 4365 area. Until you see a close above the 20-day moving average, everything to me is a hypothetical. Once you do close above that, you start seeing that a little bit more bullish. I will have I will think less of the 50-day moving average at that point.
Gotcha.
But so I do think we need to hold support first, break intraday resistance, close above the 20-period moving average. And at that point, I kind of feel like people will have a little bit more confidence in dipping their toe into this market. Ultimately, though, the bullish uptrend is confirmed above the 50-day moving average.
So baby steps, Dr. Marvin.
It's all baby steps. It's all baby steps. Oh man, that's such a funny movie. What About Bob? Every time I hear baby steps, I just think about Bill Murray and What About Bob. It's just such a funny movie.
I'm a sailor. I sail.
I'm a sailor. I sail. Yeah, baby steps. But again, that's what you deal with reversal analysis. Again, you're dealing with some volatility. You're dealing with some uncertainty. You're dealing with hypothetical scenarios that could see the market down and coming towards the 200-day moving average. This is a very mixed market right now. The things that I'm talking about are the micro elements from a technical perspective that start solidifying those charts, giving the buyers a little bit more confidence. But once again, like I said, we've seen this market in the last week and a half. Traders are willing to buy dips. They're willing to buy at the low price. They have yet to be willing to buy at the higher price, and that's about resistance getting violated. Even on the intraday, you come back down to the hourly chart. Even on the intraday, coming into resistance. Nope. Coming into resistance. Nope. So we got to start seeing that, and the confidence has to start building. And I always say this, before you get a good swing traders market, a great position traders market, that smallest time frame has to start solidifying itself, and that's the day traders, and that's all intraday analysis. And so, we spend a lot of time in the last week and a half, 2 weeks, every day in the halftime report, and the majority of the time we're looking at intraday analysis because that's the time frame that's important right now.
Yeah.
And let me say one thing, because we know the quality of the weekly chart.
Correct.
That's the point here. We know the weekly chart. I'm talking as market participants here. We know the quality of the weekly chart. We're still dealing with the choppy, prolonged bullish type retracement. When you look at the Russell 2000, that's just stuck in mud. When you look at the NASDAQ, we know that bullish retracement. When you look at the Dow Jones, kind of just stuck in mud. We know the structure of the weekly charts. We know the levels that are important on that weekly chart. But as the intraday analysis, again, as I live on those intraday charts right now, as the intraday analysis starts to solidify itself from a bullish perspective and those day traders start building confidence above resistance levels, as that starts to transpire, well, what starts transpiring as well? Those swing traders start to get a little bit more confident, start dipping their toe in. The technical analysis starts to confirm. They start to get a little bit more excited because of what they're seeing on the chart. And as those swing traders start pumping in a little bit more money from the buy side, guess what confirms the weekly chart does? And so you don't really need to look at the weekly chart a lot. We know those levels. We know what's important there. If we do get above 4360, you start reclaiming that 20-day moving average. You work yourself up into the 50-day moving average. All of that is positive metrics for swing traders. But what it also does, and why it's so important to understand this, is it also confirms multiple time frames. The swing traders start getting happy, meaning the position traders start getting happy, and those intradays to daily to weekly time frames, they start to align, and that creates a fairly decent trading environment. And all of this is happening in an environment where towards the tail end of October, what do we typically do get in November coming into December?
The old Christmas rally.
We get Santa.
Yeah.
You know, Santa comes to town a little bit to the stock market, and that from a seasonality perspective. And again, seasonality is not, you know, we don't rely on it all the time, but it's good to understand in the back of your mind, because these things have a tendency to take on a story of their own at some point. Look at September. September is historically the most difficult month. September and October is historically the most difficult months. Well, if you look at the last 10 years, it's got mixed results. You look at the last 100 years, it stands out a little bit from a price performance perspective. Does it happen every year? No, but it did this year. It did this year. Can Santa repeat that? It's an open question, but I do believe the analysis is lining up for the opportunity, though.
Well, and what I really like about where the market is today, I got to tell you, is that I'm starting to be able to map out very clear action plans based on whatever the market does. Because if I break above the intraday level, I can start to improve my delta to the upside. If I break 44.30, I can start to get more bullish. If it starts breaking down, Matt, which I don't get to determine what happens, let's say negative reactions, it starts breaking down, I know exactly where I need to start hedging, adjusting, and putting on bear trades. So the market is starting to clarify its next steps to me, but we still need to baby step it one at a time as this chart does develop.
Agreed.
All right, let's flash through the indexes if we can here. Just Dow, NASDAQ, Russell. Simple question. Just tell me if you're seeing anything that stands out.
I get this. No, I still got this in reversal, double top, double bottom formation. Interesting, 34,000. Nailed it on the low of today, started recovering. Can that form a support level? Very similar to the conversation we're having in the S&P. Can that form a support level? And does that support level give the run back up into resistance the ability to break that channel? Keep an eye on 34,000. But overall in the Dow, just a little bit of the same double bottom, double top analysis, and you're right there in the middle of the range. Well, here's another day. Here's another narrow candle within that triangle.
Correct.
In that triangle. Eventually, that triangle has to break one way or the other. So I could see some explosive volatility coming out of this triangle break. But then again, I would not have a different take on it from an overall intermediate trend perspective, though. You would still be stuck in the range between 2,300 and 2,100. Obviously, top end is 2,350. That range, I mean, my goodness, cash flow condors has just been an amazing trading system for the last 8 consecutive months, and it just continues to be a great trading system. Right now, as long as it's stuck in a range, and you heard Coach M say it yesterday, stay bored. Stay neutral. Do nothing. Like, that's what the cash flow trader mindset, though.
100%. You know, it's been a great system for me for, you know, the better part of a decade now, you know, in terms of trading neutral cash flow condors. This year has been a rock star year for it, as it's been in that consolidation range for about 8-9 months in a row. I'll actually be talking a little bit about credit spreads and cash flow during Jedi Options later in the show.
You get to take on Coach Tyler's hat there. Going to be the Jedi. What Jedi are you?
First of all, I'm the Sith Lord. Tyler is the Jedi. I actually am the one who probably taught him how.
You're the Sith Lord from Phantom Menace.
There you go.
Okay.
Stop it.
I'm on one today. I'm sorry.
Any sectors grab your attention today, Matt? Anything pop out to you?
You know, not really. Still seeing a little bit of negative reaction in technology. Comms seeing some negative reaction, but again, those two sectors we've been, you know, all over those with their negative reactions. With a little bit of solidifying itself very quickly. 9 EMA, look at that on energy coming into play here today. Pounded off that 9 EMA. That's a positive sign. Discretionary still stuck in the mud, waiting for a nice little breakout. Don't care about utilities. Real estate solidifying its support level at 44. That's interesting. Basic materials still fighting up against that resistance channel on a potential breakout. Same thing occurring on industrials. But again, we looked at the Dow Jones. You're basically seeing the exact same chart in the industrial space. And then the 125 support level starting to solidify itself a little bit in the healthcare space. And obviously that's got a nice tight backstop with the 200-day moving average right underneath it as well. So honestly, more than anything, just continuation of exactly where we have those sectors ranked coming into the week.
Yeah, no, exactly. And, until we get the next 2 days of trading, I'm not going to get too worked up about what's happening in the sectors while we're waiting on earnings reports. All right, let's flash through the commodities market real quick. Crude oil next, if we can. It's been a juggernaut. It's been strong. Vladimir Putin, who might be the greatest oil trader in the history of the world, was asked if he thought it could go to 100.
That's like saying the central bank's the greatest traders in the world. Oh, wait. They know the policy.
They know what to do in advance.
Oh, wait. Yeah. Putin can cut supply. Okay.
Yeah, correct.
When you can create price action, that allows you to be a great trader.
Does that give you an edge? Is that what we call a trading edge?
Listen, we live on the edge as traders.
Uh-huh.
Putin controls the edge.
He creates the edge as a trader.
Yeah, he has the edge.
He stated the obvious in a question directed at him. Do you think oil could go to 100? He said, of course, that is quite possible.
Did he say it with a smile?
He had the Putin
stoic the Putin smirk.
Look. Yes. No, he didn't have a big smirk on. No, he just like, that's possible.
Because the smirk is like, yeah, it's absolutely going to 100. Whereas the stoic diplomatic Putin's more like, maybe.
$100 is 25% upside. Wouldn't surprise me.
Absolutely. I think every price target's got to be in the 90 to 100 range at this point. We're kissing up against the 80 handle. This has been a very, very robust, very consistent bullish uptrend. Seeing a little bit of wickety-wick nonsense over the course of the last couple of days, but that could be simply because we have an elevated price. Look at your RSI here. Now, it's been living above the range for quite some time now, but again, it wouldn't surprise me to see a little bit of additional volatility with the elevated price action. And quite frankly, I would love to see some consolidation here in the crude space. I know we just, as traders who have bullish positions, are always like, just go up and up and up and up. Well, again, that's fantastic for the day traders and the swing traders. But let's get a little bit of consolidation and a high base and reset some of those trigger points. So wouldn't hate to see some degree of consolidation here and reset some of those swing trading parameters. But a little bit choppiness. But again, the market's been a little choppy. Crude's at the elevated price ranges, not to be unexpected. But I do believe when you're looking at this breakout from a longer term perspective and you're seeing that breakout at 75, let's go back out to a little bit of time frame here and kind of show you why people are all about that 90, 100, 110 levels, because back in time, those are where we lived. Mm-hmm. We lived there, guys. We took out a property on the beach and we literally lived between 90 and 110 for multiple years, yeah. Mm-hmm. Right? And so this does occur. And then when you look at the breakout potential of 75, there's just not a lot of real strong resistance levels till you start getting into 90. Mm-hmm. And so there's a lot of clear air between the 80 and the 90 level. And that's why a lot of Wall Street projections, that's why, and again, people that rely on Wall Street projections, it's not hard to go look at history where it was. Yeah. It doesn't take a genius to come up with Wall Street projections. They look at it the same way we do. We look at it historically. Where can crude come into historically? It's lived between certain ranges historically. 40 to 60 has been a range historically. 90 to 110 has been a range historically. And so I do believe you're talking about ultimately getting into the 90 range, but then anything between 90 and 110, I mean, honestly, that's old hat for crude oil. So that certainly can transpire. Well,
and that weekly chart does really paint a lot of that upside picture. And on the daily, let it kind of consolidate, reset. We'll have another opportunity as we move forward.
Well, that's the beautiful thing about the daily charts. I mean, the daily charts can consolidate for 5 consecutive days, give those swing traders a great trigger point, let that 90 MA catch up to a little bit. And all that does is continually solidify the confidence levels you have on those weekly charts.
That's right. Riding the lightning right there on crude oil. Gold next, by the way, speaking of something that actually is jumping out
pounding
here
the table today.
Ooh, I got to tell you, man.
Did not like my commentary of like, let's move on yesterday. It's like, wow, I should have spent a little bit more time. I do like GDX though.
One of my favorite new things to do with you is ask you for technical clarity on some of these charts, Matt, because we did a podcast.
See the green line?
I do see it, but I have a different question.
We can talk about when it gets above it.
Is that an inverted head and shoulders on the intraday that now is taken up to the upside?
Daily?
Am I just getting too excited here? Because you know my bias. I'm biased towards gold.
Pump those brakes, brother. Pump those brakes. We've talked about this. It's obviously, yes. It is. When you're looking at it from a short-term perspective, you see that level right there? Mm-hmm. See, we do this every day, Tim. Every day.
Epic pen.
That's right. Epic pen. But you see this price threshold? And let me draw it for you guys. Right there. Let me get my thing. See the price threshold right there?
Uh-huh.
Right there.
Shoulder, head.
And then the consolidated one.
Shoulder.
That creates the head and shoulders formation. All right. Mm-hmm. So you have the head, the left shoulder, you have the head, you have the right shoulder. Now the right shoulder is where the real analysis starts to come into play, because once again, up until the right shoulder, all you have is a bearish downtrend. That's it. But once you increase support, that shifts the pattern. And then you break out of, and there's a couple ways you can identify a breakout here on an inverted cup and handle. But when you're looking at the trend line, i.e. the neckline is one way that you can identify where that becomes some degree of bullish uptrend. So number one is the neckline. Number two is the horizontal range. Now, whatever gold did today, it broke through all of that. I mean, literally every single degree of that. And so you certainly got to wake up to the price action on gold. There's no doubt about that. But I'll say this, and I've said it a few times, I'll say it again. Until gold's chart starts breaking up above 1835 by 1840, I don't care. I feel like this is us analyzing crude, but loving energy. I love the potential reversal analysis that is building on gold. I do. But the argument I've been making on gold and it is the stabilization argument, that all that I'm looking for is gold to stabilize at the low prices, because I feel there's a value opportunity on GDX. And even though that got tested underneath 30, remember the backstop of GDX and the backstop of the argument was you got the 200-day moving average right there at 28.30. And so I do still like the opportunity on GDX, and with the gold movement happening here today, I do think that's going to exacerbate the price movement in GDX as well. And so you're seeing a nice little pop and move. But here's one thing that we have not seen on GDX in recent history. We haven't seen it reclaim the 50-day moving average.
Yeah, no, it's not out of the woods. Okay. Neither of these are out of the woods.
No. It got drilled here at the 50. It got drilled there at the 50.
Correct.
It didn't even care about the 50-day moving average today. I do think that is telling. And so I think that's further evidence that the value argument at $30 on GDX with the stabilization of the gold charts towards the lows, I think that is still a valid argument, even though, it did test us a little bit underneath 30.
Well, and simply put, somebody who loves covered calls and loves having balance in my portfolio, not all tech, not all growth, not all this. I love having GDX in there for covered call analysis, for equity analysis, different things I can do over time. And one real quick question on this gold thing. Okay. Give me the weekly chart on both of these products, one real fast. GDX is showing me relative strength the last 2 weeks against gold. Does that even get you more excited? Because these are two strong green candles off the 200, where gold is more still in that neutral range, starting to push. Does that get you more excited about GDX, that relative strength, or does it not mean much to you? Like, is there anything there?
It adds to the argument, but again, I started making that argument before these two green candles existed.
Correct. That's right. We were here. I remember it. Yep, absolutely.
So I think it furthers the argument. It's more evidence to the argument. it gives you more confidence to the value argument, and the argument is the value argument at $30 on GDX. But yeah, I think it more than anything, it increases the confidence in it. And you certainly love the GDX getting back above the 50-day moving average. Now, again, I kind of feel we're a little bit overextended on those daily charts at this point. But again, I do think it adds to the confidence level, but I don't think it changes my argument on GDX versus gold, though.
Yeah, and that's fair. And by the way, it's not just this metal that is improving here today. Silver's looking pretty good. Copper's looking pretty good. Platinum's looking like a breakout.
Let's
We're
go
seeing
look
these
at
metals.
Copper.
You got
look at copper breaking out, double bottom, reclaim everything, breaking out. Let's go look at our darling. Everybody knows our darling, right?
Freeport McMoran.
Everybody.
Yes.
Everybody knows Freeport. Let's get some price confirmation. Freeport, good, very important earnings coming out on Freeport coming up soon.
Absolutely. All right, very good here.
Let's keep anything on silver very quickly.
Little reversal characteristics starting. I mean, it's early on silver.
Little reversal, but 22 is very important to silver.
Yeah,
it's very, very important to silver.
You know,
I can definitely see people lining up and taking action at 22.
The best reversal out of all of them might be platinum, and I don't trade platinum. I track it, PL, but I track it, but I don't really trade it.
But I don't trade PL either.
Got daily charts looking good. All right, let's flash through the rest of it here, and then we got stock talk. Bitcoin, last one. There's nothing to update on Bitcoin today. I did see an official report that the United States has taken over as the largest Bitcoin country of mining in terms of mining the product and all that kind of stuff. China banned it recently.
I said it a couple weeks ago. China, your loss is our gain.
That's right. Somebody else is going to pick up the demand.
Somebody else is going to pick it up.
And here we are up pushing towards 58K. Feels like 60K is destined. We'll break that down when we get there. Anything on that chart you want to update? Now let's talk stocks, Matty. Let's do it. All right. By the way, real quick, every time I make a transition, I always have a little thing I want to remind myself of is to promote something we do at Tackle Trading. We're going to be covering companies in the news here today in Stock Talk. And the podcast I do every day for Tackle Trading is called The Huddle. 5 o'clock Eastern. You can find The Huddle right on tackletrading.com. I break down all of these companies as we go through earnings season, Matt. You're going to be analyzing them in detail in the halftime report, charting, price response, all the numbers. We'll give the news in The Huddle at 5 o'clock Eastern in case anybody needs them, in 10 minutes or less every day to get caught up on the news. So make sure you subscribe to The Huddle out there. There's some big ones, Matt. Where you want to start?
Oh, let's start with the big one. The big one is JP Morgan.
All right.
JP Morgan Chase, 430 billion market cap. A little bit less here today, though, as it's down 2.66%. Now, let's go through the raw numbers here, Tim, on JP Morgan. First bank to report, but again, there are a lot of banks to report. So first one of many over the next week and a half for me. JP Morgan comes out with a very decent EPS number, $3.74 against $3. Revenue came in above expectation as well, 31 billion versus the 29.7 billion expectation. That was basically flat year over year. So a beat and a beat. Now, JP doesn't provide us any detailed guidance, so let's just give them the official beat and beat here. But there's a little bit of context to understand that beat. First and foremost, JP Morgan released $2.1 billion in pandemic credit reserves, which certainly aided to the 74-cent beat here on the EPS number. That's number one. A couple positives. Equity trading was up about 60%. Unfortunately for that, fixed income trading was down 30%. You also had positive here. Mergers and acquisitions on fees exploded by 187%. Very good, healthy quarter for mergers and acquisitions for JP Morgan. Unfortunately, loan origination, credit cards, and consumerism 101 type stuff, i.e. debt, that did not follow suit. And so debt actually had a 21% decline in credit card income. They also had a 2% decline in loan origination as well. Those are two fairly big concerning data points for JP Morgan. So officially a beat and a beat, but there is some concerning headwinds coming down the pike. One, i.e., when are the consumers going to come back strong? We've seen some of the business side of JP Morgan's revenue streams come back strong, i.e. the mergers and acquisition fees exploding by 187%. Equity trade. We knew equity trading. Guys, think about this. We've said this for 2 weeks. the trading was going to be strong out of the banks. If JP Morgan saw a 60% increase in income, what do you think Goldman Sachs is going to print?
Yeah, trading profits are going to
like
be
Morgan
strong.
Stanley, Goldman Sachs, their trading profits are going to be pretty strong here. But again, for every positive that you could point to with JP, you could point to some degree of a negative here. And we started this earnings season, and Tim, I don't know how many times I've said it in the podcast multiple times. I've said it over and over here. This is not the environment or the season where you can have mixed results. It is absolutely not. So officially a beat and a beat, but we understand how you releasing 2.1 billion in credit reserves helps that EPS number. For every positive you can point to in the revenue, you can point to some concerning data. That's enough to come off any buy side metric. Now it's about seeing JP Morgan and how JP Morgan handles that 50-day moving average. Can we see a doji at 160? Because again, we do have a beat and a beat. There's just some mixed data here. I do think there could be a trade setup on JP Morgan. We got some other banks to follow, though. I want to see how JP Morgan handles that 50-day moving average. Right now, it's a test. We haven't seen it pass the test. Let's first see it pass the test. But again, completely understand the drop in price here today on JP.
That is one open question I am going to be paying very close attention to as we break these earnings seasons down is how did the consumer do with these type of companies, right? The credit card miss and the income around those type of services, that tells me people worried about Delta variant, inflation, and all the stuff that I read in the economic data in August and September that every company was warning about. Looks like it came through translation in the last quarter. So
it's early. It's early, but it's a storyline to keep an eye on, no doubt.
Mixed results, negative response, still within the market maker move. There's no trade in the immediate future in any regard for me here. Anything in the chart that stands out to you?
Again, need to see a test of the 50.
Yep, let's do it. It's got to hold that doji and show something else. All right, let's go next.
Well, let's we started with one of the biggest banks.
Okay.
Let's go with the juggernaut asset management firm BlackRock here. Now, again, one key thing to look at here. JP Morgan was near the highs, BlackRock near the lows. That plays a role here. BlackRock Financial, a very similar report to what JP Morgan did. They came in above the expectation on EPS, 10.95 versus 9.54. Revenue came in slightly above the expectation as well, 5.1 versus 4.9. Revenue increased about 15% year over year. A very similar report. I can point to very similar concerns here. They did not achieve, and one key metric to keep an eye on BlackRock that's just more curious. They came in at 9.9, I think like 9.54 trillion, 9.5 trillion, billion under assets under management. They're real close to that 10 billion number. They could get there in the next quarter or two. That's just something to keep an eye on. Assets are coming in under management for BlackRock. That's a positive. But again, very similar report. The difference for me is very simple. If BlackRock was towards the highs, you would see the exact same price response that you saw in JP Morgan. It's not. It's towards the lows. Slight beat gets the increase coming off the 200-day moving average.
You know, BlackRock is a candidate for a split, by the way. When I see these $900 price tags,
a bank, 100%.
Yeah, come on, get down to where we can play it for cover calls and all that kind of stuff. Candidate for a split. One interesting thing about the company, Matt, and I've heard the argument, not from you necessarily, but I think you and I could maybe have made this argument. BlackRock might be the best financial company in the market in some regards. The assets under management is impressive. What Larry Fink has done is very impressive.
I agree.
Reversal characteristics here, Matt, on the daily that is leading me to look at the weekly chart. Is there any opportunity here on BlackRock?
Well, and that's the one you're looking at. And a lot of this, whenever you look at something coming off the 200-day moving average, it always does you a little justice to kind of look at that weekly chart. And because you see something coming off the weekly and you're like, wow, is that an opportunity? Maybe not. I mean, it depends on what the growth was before the retracement to the 200-day moving average. I don't see it here, Tim, from a technical perspective.
Still too early.
Well, number one, you got a lot of chop between where the current price is and $900. You got a lot of weekly moving averages. Obviously, the 90 MA on the weekly kind of got kissed here today. I don't see this one on the weekly, no.
Got you a little early. All right. I like that company. Position traded it in the past. Haven't had one in a while on BlackRock, actually. It might go back on my radar for maybe a month
You
down the
give it
road.
more time, a little bit
Yeah,
more analysis coming into it, the technicals can solidify himself. But I just
not
see
yet.
way too much chop between. We're talking about an $870 stock, and I see a tremendous amount of chop between 870 and 900.
It's not a
So
company you need to be in a
yeah,
hurry in, by the way. You don't need to be in a
yeah.
hurry with BlackRock. You can be patient. All
Well,
right.
and if you had more price appreciation in the quarter followed by a retracement, that's a different technical setup. You didn't. You had neutrality, a pop, and a drop, and it just became very choppy.
Gotcha. All right.
Yeah.
Next.
Last one I want to cover here is the Delta Airlines here. And let's talk a little bit about Delta. Delta's raw numbers were actually fairly decent here. Delta came in at 30 cents a share. The expectation was only 15 cents. So a really good beat from Delta on EPS numbers. Revenue came in pretty decent as well. In fact, I'd say it's fairly impressive. Came in at 9.2 billion versus the expectation at 8.5. That exploded year over year. Now, mind you, again, context matters here. Last year, airlines dealing with some really, really nasty stuff. This year, airlines dealing with some really nasty stuff. So only one nasty instead of two nasties, but it's still an improvement from an economic condition perspective. So that revenue did go up about 199% year over year. Very good number. So EPS beats really impressively. Revenue beats really impressively. Revenue explodes year over year, 199%. I'm certain there's a lot of people wondering what is going on, right? Again, number one question coming into, and why I didn't talk about JP and why I didn't talk about BlackRock, they don't provide guidance the same way the Delta does. Delta provided guidance. And Delta said they are going to contract their guidance. And so they lowered their guidance coming into the fourth quarter. They were expecting 8.73 billion. They lowered that guidance number to 8.29 billion. And the drop in revenue was largely stated based on something that we've been talking about a little bit in recent history, and that's how we're all geeking out about the rising fuel and how that's increasing energy companies' price, right? That's benefited a lot of traders. There's no doubt about that. Traders that have been in crude oil, they've been just enjoying that gravy train. Traders that have been enjoying and how many of you tackle traders are out there and you're saying, yeah, I love what's going on in energy. I keep going up energy stocks, keep going up energy stocks. Well, energy stocks are going up based on one simple argument. The rising value of crude oil will help their revenues over time, which will lift up their stock price. Well, here's Delta today saying, well, this isn't beneficial to everybody. And the airlines chiefly among them. And I wish I would have talked a little bit more about it a week and a half ago, but I didn't want to get on a soapbox. But the simple reality is, as these crude oil prices go up, Delta, American, Southwest, United, these airlines, they have to offset the rising fuel cost. Now, historically, they have offset the rising fuel costs in two different ways. Number one, they have done that through rising prices. That is a very difficult thing to do right now for the airlines because their demand is still nowhere near where it was pre-pandemic. It's improved.
Picking up a little bit. It's picking up a little bit.
A little bit is not even within the margins, and the margins are where Delta makes money. Like literally within the margins of where Delta makes money. So when you go when you're still 30% underneath your pandemic levels, and pre-pandemic you were barely showing a profit then, now you're 30% under. That's going to have a big impact on your revenue stream. And so the number one way airlines pass on that cost is simply through increasing the cost of tickets. Very difficult to do when you don't have the demand to offset that. That's number one. And the second way is they literally will trade within the futures market on crude, but they ain't doing it as much as they used to. They should. They should, but they're not doing it as much as they used to because in 2014, 15, and 16, they were burned to the tune of writing off billions of dollars in losses because of what Saudi Arabia did with their war on the frackers. And so they're not doing a good job offsetting the rising cost. And so they have a lowered guidance here. And that's the storyline that why Delta is selling off aggressively. It's not due to what they did in the quarter. It's due to what they didn't do in the quarter. That's offset some of the increasing fuel costs. They have to put that into the projections on revenue for next quarter. That is where the downgrade comes into play. Thus, Delta comes down. Delta's showing you how important guidance is right now, guys.
100%. And I think there's a lesson there. And we're going to get that lesson over and over and over throughout earnings season. And to me, this is that true mixed bag. Legitimately. I mean, you have to be impressed with the company's ability to turn around from last year to here. You know, the losses they were experiencing during the pandemic, the lack of travel, lack of demand, lack of everything, they did turn it around to post a profit and beat raw numbers. But yeah, those rising fuel costs obviously are going to impact.
I'm sorry, trading is a very simple game. We're thankful for what you've done in the past, but you got to show me the future too.
It's about the future, man.
And Delta, unfortunately, said it's not going to be a great ride for the fourth quarter.
Yep. Some anecdotal stuff that's giving you some optimism. Atlantic travel bookings are up. Business travel bookings are up a little bit, but not to pre-pandemic levels. And with the fuel where it is,
let's talk about that very quickly, because that is one thing that for the fourth quarter can be a very big impact for Delta, American, and United. The Biden administration opened up transatlantic flights and travel starting in November. Okay. Now, again, Delta and all of the revenue streams are down across the board for all the airline companies, right? Even today, Delta comes out and says, hey, our guidance is down. This is something that's happening right now, though. When the Biden administration opened up for transatlantic travel in November, Delta stated they saw a 10-fold increase in bookings immediately. So some of these negative headwinds that Delta is dealing with, they can be offset if we do actually start to see that those bookings start to increase dramatically from a transatlantic perspective. Now, that travel, just that travel, transatlantic travel accounted for 17% of all revenue of Delta, American, and United for 2019, which was pre-pandemic, right? If that comes back, even to a certain extent, that can offset some of this concern from Delta. And so kind of like we were talking about with JP Morgan, mixed bag analysis so far in earnings, guys. There's absolutely some positive things to hang your hat on in JP Morgan, in BlackRock, and yes, 100% in Delta. They posted really good numbers, 30 cents against 15, revenue 9.2 against 8.5. The headwind coming at them, rising fuel cost. That's the headwind. Can that headwind been offset by them increasing transatlantic travel? That is something to keep an eye on. And specifically, though, just for American, United, and obviously Delta, the big three.
Gotcha. Love it. And appreciate the breakdown on all these earnings, some good, some bad. We got the takeaways here, and that price response leaves it now trying to hold, I guess, at $40.
But again, think about it for a second. Still, Delta getting smacked in the face here today.
Yes.
But
market's not.
Industrials, not.
Yeah.
Okay. BlackRock getting smacked in the face. Well, not BlackRock, but JP Morgan. But finance is recovering intraday. Start of earnings season has not been great, but the market is still in one of those. I understand that you're not as happy as you might want to be with the earnings performances, but we still like 43.20. We still like that number. Market's still it's still going up in the face of some of this negativity. We'll see if it follows through tomorrow and the next day.
I think it's an important point. All right, I got a couple quick more ones here, Matt, and then we've got a planned segment here today called Jedi Options. Tyler usually does that. I'll be doing that and teaching you guys a little bit about bear call spreads right now in the market, especially on the Russell 2000 here in just a minute. There are a few stories though we cannot skip. Apple Computer is one of them. Apple, and you brought this story to me this morning when I was drinking coffee, hanging out in pre-production. Apple's likely to cut its iPhone 13 production by as many as 10 million units, citing global chip shortage is one of the problems. I also want to look at Texas Instruments and Broadcom in a second for that. Obviously, Matt, this is their number one product. I've even made the argument to you that I think Apple should be a consumer staple company because we purchase these phones regularly and we all use it as that type of product. When you're cutting production, and we know global chip shortage is been in the news for a year and it's going to continue to be it through 2022. This is a problem. Matt, what was your read on this news story, Apple cutting production on its most important sales product?
Just a continuation of what was seen in a lot of other areas of the market. And obviously, we're going to continually talk about supply chain disruptions probably for the next 3 to 4 quarters.
Mm-hmm. Yeah.
That was my only take. Like Apple's big. They're the number one company in the world for a reason.
Mm-hmm.
But supply chain disruptions coming out of China are bigger than Apple.
Yep.
As simply as that. Apple's going to be prone to the same economic impact as everybody else.
Mm-hmm. And they specifically cited that some of the suppliers are having a really hard time supplying the product. You know, Broadcom, Texas Instruments, some of the people they have contracts with. So it is what it is. Another chip shortage issue here.
Maybe Apple should start making their own chips.
Could do that.
And maybe we should make them here in the U.S.
Could do that as well.
I'm just throwing it out there.
Couple ideas. You bet. You bet. All right. Next one, Plug Power. PLUG. Couple stories on this one and an interesting chart reversal characteristic. Number one, they caught an upgrade at Morgan Stanley, increasing their price target from 35 to 40 and putting it into the equal weight category. They had it as an underweight, so caught the upgrade. They also announced a partnership with Airbus to decarbonize air travel and airport operations. Some of the products that they've built within different U.S. airports, I think revenue is going to go up because of that. But maybe the most interesting part of this is the chart itself, Matt, just the reversal characteristics after the SPAC merger blasted off. It's had all this time to digest it. What's your read on this company, the news, and the chart?
Well, the news is certainly positive here. Nice little upgrade down at JP Morgan and Chase. Technically here, I kind of find this very interesting. I kind of feel this is like a little bit of a breakout Frank type special here, where you got this old resistance channel that coincides really nicely with the weekly 50-day moving average that Coach Frank and Coach Mark put a tremendous amount of emphasis on. You come back to the daily chart here. Obviously, you're overextended. The 200-day moving average is right there at about 35.30. I think this is one of those storylines that happens over time, Tim, where it sparks your interest, right? It sparks your interest, and that's what it did for me. It sparked my interest. Technically, I see a trigger point. I do see a trigger point, and that's right above 35. Okay, so that's where I would say triggering it above 35 clears the old nonsense over there. It clears the 200-day moving average on the daily chart. You come to the weekly chart right there at the weekly chart. I think the 50-day is right there around 34. So if you clear around 35.30, you're getting up above that 34 50-day moving average, 35 the 200-day moving average, and you're clearing the old consolidated resistance level as well. Once you clear that, there's not a lot to 40. There just isn't. And so I think the target would be 40. You do have a little bit of old support here of 40, but after 40, it's just nothing. It's in no man's land of no price action, no resistance, no support until you start getting north of 60. And so technically, yeah, I did get interested. There's no doubt about that on a positive news story. For me, and this is just for me because I don't like chasing, I do think we need to see some degree of patterns develop. I think we need to see some consolidation. I think we need to see any pattern develop here, like any pattern. There's no pattern to it right now. And so I think we need a little bit of time, and that little bit of time could coincide nicely with the earnings coming up second week November. But again, this is one of those ones where put it on the radar, get it on a watch list.
That's right.
Track it over time.
That's an obvious call for me. Get it on a watch list, start keeping track of it, get ready for the next pattern to develop and emerge. Nice little story.
And whoever
today.
nailed that first breakout yesterday in front of JP Morgan, oh, congratulations. That was a good breakout.
Great job front running that one. I like it. All right, guys, that's it from a news perspective. What we're now going to do is, Matt, I'm going to go into Jedi Options, start doing a little teaching here today. You know, Coach Tyler is on vacation, and we do want him to enjoy his vacation out there, but I don't want to let an opportunity to teach everybody out there something new. I do want him to enjoy it. Why not?
It's 5.
Yeah. All right.
How many vacations do you need?
Whatever he's, dude. Who knows? Who knows? I honestly don't know if this is the boys heading out to play golf or.
I kid. I totally kid. 100%. I want Tyler to have the most amazing, beautiful time on his vacation. But I love Tyler, which means I'm going to give him some. I'm going to give him a little bit of brotherly type, you know, wink, nod type stuff.
100%. And I'm going to give him that hard time when he gets back, by the way, telling him that he was a coward, wouldn't take me on to Trade Masters here tonight. But that is neither here nor there.
Oh, wait. Is this the narrative we're running with?
Yes, of course we are.
This is our Fed narrative? This is our made up Fed narrative?
He ran off.
He ran from Coach Tim.
That's exactly right.
He ran from Coach Tim. Everybody a tackle. This is our narrative. We're going to make it up the same way the Fed makes up their narratives. This is our narrative. Tyler went on vacation to run from Coach Tim.
I believe it. Why not? I'm the one saying it. So I got the mic.
Listen, it's as believable as saying the inflation is transitory.
Oh goodness, it's too much fun for me. I'm gonna give him a hard time.
I'm sorry. I'll take a step back here. You enjoy, bro.
Let's get into the education here. So out there, if you're team tackle, one thing I was talking to Matt this morning, we're thinking about, okay, what could we highlight today that would make a lot of sense from a, you know, just a strategy perspective, something that we know that everybody could, you know, get some value out of learning about and all that kind of stuff. And one of the best things that's been happening in the market this year for traders who know how to take advantage of it is neutrality. Okay. And there is a vertical credit spread that we teach in our tackle trading playbook over on tackletrading.com. I'll show you where to find all this information here in just a minute, called the bear call spread. It is a classic spread. It's a vertical spread where you sell a call option, you buy a call option. Now I'm going to teach you the bear call spread just from a theory perspective for a minute. Then we're going to got a couple of examples within a trading system that we use on the Russell 2000, where we're going to dig into some of the detail about how to use bear call spreads potentially in your trading. Bear call spread is fairly straightforward. You know, once you learn options mechanics, and obviously we'd recommend that you go through the options 101 course if you don't know about expiration dates and deltas and all that kind of stuff. But the definition of a bear call spread is where you sell one call option. You then buy one call option in the same expiration month. Okay. So you have one sold contract and one purchased contract. That's what makes it a vertical. The one you sell has to be worth more money because the net value of a bear call spread is a credit spread. In fact, in the chat, if you can just type in credit spread, that is often what they're referred to as a type of strategy in the marketplace. So we sell a call option, buy a different call option in the same expiration month, just with different deltas. It is a bearish cash flow strategy. Now, implied volatility falling helps the trade. I'm not going to get into that too much here today because it's naturally mitigated within the vertical anyway. The basis of the strategy is two things. You have to believe that the level you sell is far enough above you that the price is not going to exceed it. You want to be at a low delta when you're doing that. And by doing that, by creating those characteristics in your strategy, what you're doing is you're creating a cash flow opportunity where you get to keep the money you sold for a credit if the trade works itself out. And I'll show you a couple examples here in just a second. So when you're spreading options, it does require margin. You have to have an options account. You have to have access to generally what most brokers call level 2 options trading. And if you're brand new in the options market, you don't know much about any of those processes, that's okay. You're in the right place because that's what we do is we teach options how to go, our option traders how to go from brand new, never doing anything to where you actually are applying techniques in the market over time. So this is the definition of a bear call spread. Couple of things that we want to see behind it. Okay. Technical analysis. The chart should be neutral or bearish. You can absolutely play these on neutral charts. The Russell 2000 has been neutral for 9 months in a row. it has had wonderful opportunities to trade bear call spreads most of the year. Okay. So it needs to be neutral, which is a 0 bias, or it needs to be bearish, which is a -2 bias, up to that. The option Greeks, okay, it's a theta strategy. In fact, in the chat, one of my team tackle members, if you can put in theta strategy. In our playbook design, what we do at Tackle Trading is we lump every technique or into a categorization. And our categorizations are based on the options Greeks. Delta for directional strategies, theta for time-based strategies or cash flow strategies. And then Vega would be volatility strategies, which there's a lot of appropriate techniques in volatility right now in earnings season. But this one's a theta strategy. In the playbook, a couple things to be aware of. Number one, check the earnings date in the news. Now, we're going to do one today just as a hypothetical example on an index. There's no earnings on an index. You know, one of the things I love about the Russell 2000 trading system is it's not on individual companies. So like Delta Airlines or, you know, JP Morgan today wouldn't have to worry about the earnings gap or whatever it might happen with the technique. Check the earnings and the news on every company you ever trade. If you're trading individual companies, never trade anything you haven't practiced before. These are some pretty standard bits of advice for any trader out there. Get into a virtual environment, get into a back testing environment, join a trading lab with Coach Gino or Greg or something like that at Tackle Trading and learn how to practice it. Until you've done something 10 times, 15 times, 20 times, 25 times, 50 times, whatever it might be, you've got to have experience in anything in life and learning how to enter, learning how to manage, learning how to exit. Those are important tactics for any new cash flow trader, no question about it. So make sure that you've practiced it and build your rules out specifically. And what I would recommend, just use the rules that we build at Tackle Trading. Those are based on decades of experience and back-tested rules and all that kind of stuff. Here's how you build the bear call spread, okay? Number one, you have a delta rule. We want low deltas because a low delta indicates a high probability of success. Now, the core rule is that it has to be less than a 25 delta on the short call that you sell. It also needs to be above resistance. You don't want to sell a bear call spread in the middle of a price range. You don't want to sell your short strike price below the resistance point, because resistance from a technical perspective is what is going to help you with the charting. You get above that resistance, you feel like you've got the cushion, you know where your stop out point is, you know where to make a management decision when there's clarity on the resistance. So you want to go above that resistance. Now, for me, when I sell credit spreads, by the way, guys, I'll go as low of a delta as I can, where I still get good credit, okay? Now, if I can do a 20 delta and I feel very great about it and I get a big fat credit, yeah, sure, I'm going to go with that. But if I can get a 10 delta or a 7 delta or a 5 delta and still feel like I'm getting compensated for my risk and my margin, and I can build some cash flow around it, I'm going to go a little bit lower delta as well. Now, when I'm building bear call spreads, I like to have 5-point spreads or bigger. It depends on the size of the stock. We'll do an example here on the Russell 2000. Your theta rule. When you're building a strategy out, the theta rule is the time till expiration rule. All right. Now, in general, when we're doing credit spreads, we want to be less than 60 days of time, 60, 65 days, and then lower. The Russell 2000 system actually sells like 65 days, but you can sell 30 days on these credit spreads, by the way. I really like the sweet spot when I'm doing verticals between 30 and 45 days personally. That's where that 4 to 6 weeks of time comes in, okay? So when you're going into the option chain, you're selecting an expiration date, go 4 to 6 weeks out. You can go up to 60 days out, but make sure you're sticking within those windows of time decay. Last one, Vega rule. Volatility falling helps it. It is not mandatory that you have a certain implied volatility relationship. This one is more nuanced and for advanced traders that if you get it, it gives you a little bit more of an edge. So you have a little higher probability and all that kind of stuff, but I'm not going to base this decision just on volatility alone. Position size has to be according to risk level. In any credit spread, you can lose what you put in on margin. So you got to understand that. And you got to keep those numbers relatively low relative to your account size, Because one of the key things in trading, and really just got a little something in my throat. Apologize about that. I haven't to clear it, but 1 second. One of the key things in trading on position sizing, make sure that any decision you make in the market is just one decision. You know, we're going to find beautiful breakouts. We're going to find beautiful breakdowns. We're going to find delta opportunities and theta opportunities and everything in between. If you're an active trader at the end of the year, how many trades do you think you will have made? Dozens, hundreds, some of you maybe even thousands, depending on what type of trading that you do. You can't ever, or you should not ever, I should say, you should not ever put yourself in a position to where one trade is oversized so much that it puts too much risk on your portfolio. So position sizing is key. And that's something that you should work on with your coaches if you're in one-on-one coaching or in the labs or whatever it might be. Make sure your position size rules are detailed. And then for me, my ROI target, I use the tackle theta spreadsheet to build those ROI targets. I'll show you how to do that here in just a minute. We're looking for 70% ROID or higher for a bear call spread. Now, this is the risk graph of what it looks like visually once you build it into your Analyze tab. What I want to do next, actually, is go right in and build one of these for you so you get an example of what I'm thinking about here today. Now, by the way, if you're out there and you're watching this right now, and I'm finally got the chat back up, if you are learning, just type in the word learning in the chat and let's keep the energy up. I'm looking at all this content coming in. I appreciate you guys' energy out there. A couple things on the bear call. Here's the Russell 2000. Matt has been breaking the technical analysis down day by day for years here on the Halftime Show. If you are a veteran of our community, you come here every day, you know this is a neutral range for a very long time. Now, if I go back to the weekly chart, okay, I can identify a couple of different things here. You know, I'm going to come down to a drawing tool. Look at the consistency of the support level down here. This zone. Every time these weekly candles dip in between 2100 and 2150 or so, we're finding some support throughout the entirety of the course of the year. Look at the consistency around the resistance that has been pushing it down. Now, there's two levels that are grabbing my attention right now. 2300 and then much deeper at 2360 or even up to 2400. 2300 is the next pivot point that you would have to pay attention to if you were a trader. Because if you put the bear call on, what you're wanting to have happen is for it to stay below these resistance levels, right? It's a neutral cash flow strategy, or bearish. We want one of the two things. Now, the rut, the whole point here, by the way, and one of the assumptions that I made when I decided to do a bear call spread here today is that you already have the bull put on this strategy. Traders who trade the Russell 2000 iron condor system, and just type in the chat, type in cash flow condors for me if you can. Just type in cash flow condors, okay? It's a system that we use at Tackle Trading. It's a very, very popular system for the veterans in our community. People who've been here in Tackle Trading for a long time might have been trading those for years and years and years and years. Coach Tyler was the architect of the system. I'll talk a little bit more about it in just a second. In the cash flow condor system, you already have, and I wish I had the Epic pen now, you already have a bull put on, so you are expecting support to hold, okay? Many traders, though, don't have the bear call on. And as the market has kind of moved into neutrality the last month, you know, as we've had a pullback, as the Russell has been neutral for a long time, adding the bear call on can increase your overall net cash flow, all right? So that's why we're teaching the bear call spread. 2300, 2360, and then even deeper for cushion is what I'd be looking for. So if I want to go into the option chain and actually build this out, I then am going to open up the Analyze tab in Thinkorswim. I use Thinkorswim when I trade options. I then will go into a different expiration date. Now for this one, I'm going to build the 36-day option out. Let me adjust my strike prices, put in 60 here or so. And just so that you guys can see it visually, I'm going to build a bull put side of this as well, maybe down here at 2000, something like that, right there on that level, okay? Now, here's my delta. That is a bull put spread. Now I'm teaching bear call spreads. Assume you already had this one on. Now, bull put spread on its own is bullish. You want the stock to go up, the index to go up, or whatever it might be. By adding a bear call spread on the other side, we are turning it into a neutral strategy, okay? So in the chat, somebody type this in for me. Put in bull put spread plus bear call spread equals neutral cash flow. Bull put spread plus bear call spread equals neutral cash flow. So if I'm going in to do that, there's a couple of different things I'm going to start with. My eyes instantly go to these delta numbers. You want to set up your option chain so that you can find delta very quickly. I'm going to give you guys some advice out there if you're new, if you're intermediate, or if you're a veteran, all the way in between. Use option Greeks in your trading. Use delta specifically to help you understand strike price probability, okay? Cushion, all of those kind of things. It's such a critical concept, is the delta concept. So I'm going to build delta in here, and I'm going to go directly down. First thing my eyes are going to do is find that one right there. Now, why? Well, when I was going through the little PowerPoint slides a minute ago, what I was showing you is the number one rule we had on the delta rule is it has to be 25 or lower. So because my rules tell me I have to be at that location or lower, I just mark it. I mentally identify it from a level perspective. That delta is at 2330, okay? So if I build the 2330, 2340 bear call spread, you'll notice a couple of characteristics. Here's my trade. A 25 delta means I have a 75% probability of that option expiring worthless 36 days from now when it expires. All right. If it does happen, I get to keep this credit right here. Now, the aggressive delta gives me a credit of $2.80. That's a big credit. $2.80. Let's look at the order form. Oh, it's got 25 contracts as the default. Hold on, let me change that to 1. Easier to always do the math just on 1, whatever you're going to do. All right, confirm and send. So here what would be happening here if I put this trade on a 275 credit, 275 potential in max profit against 725 in potential max loss. If you add those two things up, you'll notice it's $1,000 total, because a 10-point spread with one contract on the Russell 2000 is $1,000. Somebody put that in the chat for me. I appreciate the way you guys are typing in there. It helps me make sure you're getting the stuff I want you to get. Put in one contract, 10-point spread equals $1,000 total. Whatever your reward is versus whatever your margin is, that's what it's going to total up to on this particular technique, okay? I don't like this spread. I'm going to tell you why I don't like this spread. 2330 on the Russell 2000, it puts me in the middle of a technical location that does not represent what I'm trying to do with it. I wouldn't have a problem if somebody said they wanted to play something aggressively neutral, get a real big fat credit, go with the delta that is higher if they understood the risk and the management. But if it breaks above this pivot, I don't want to have to micromanage this trade. I trade credit spreads because, kind of like Coach Emily talked about yesterday when she was doing her, Queen's Court analysis, I want this particular trade in my account to kind of be a lazy cash flow trade. I don't want to have to micromanage it. I don't want to have to stare at every intraday tick on it. What I want to do is I want to come way up here somewhere, 2,400, 2,420, something like that, and actually give me a little bit more cushion. So what I'm going to do is I'm going to go back into the option chain. I'm going to uncheck the aggressive 25 delta. I'm going to go back into a simulation, and then we're going to keep moving down the option chain. Now, here's a lesson. The lower the delta, the bigger the cushion you have, and the higher the probability you have inherent in the trade. So if I come down here, I'm going to start with that 10 delta right there. That corresponds me right at $2,400. And I'm going to build a 2,400 by 2,410 credit spread. Now the math here would be 90 cents credit. And again, it defaulted me at that 25. Let me change that. Put 1 in here. Okay. It would be $90 credit. So the most you can make is 90 bucks on $910 in margin. So you have to have 910 to put the trade on. All right. But with the delta where it is, using the 2400 strike, I have a 10 delta, which infers to me mathematically, I have a 90% probability of the trade expiring worthless and me capturing the credit. Okay. Now, a lot of the details of how probability works and how delta works, you're going to have to get in some courses for that kind of stuff. Let's just focus on the actual execution of what I'm talking about here. So if I go back into the rut and look at the chart, adding the neutral trade puts me up here, and remove that. I need that epic pen now. It puts me right here at 2400. So by going to the lower delta, I then have the cushion between here and here. You'll remember the premise that we started with by adding the bear call side of it is because I wanted to balance out the assumption that a condor trader already had the bull put on. The bull put in this example is at 2000, which would be here. Okay. So now what I've done is I've taken a trade, adding one side of it, converted it to neutral, increased my overall cash flow expectation, given myself some cushion to operate in. And one of the things I really like about this, guys, because I'm a bullish trader, I really am. People, and there are times I've been called Timmy the Bear. There have been moments I've been very, very bearish. There's no doubt about it, like any other trader would be as market conditions change. But my net bias in the market over the long term is always going to be to the upside. It's always going to be bullish in that regard. In these markets that have moved neutrality, though, what I can do is I can add bear call spreads on to existing positions to neutralize them, to balance my portfolio, to put me into a bigger cash flow expectation, all of that kind of stuff. So the lesson here today, and hopefully you guys got some value out of it, is around the bear call spread and adding it to the analysis. Now, one thing I also did when I was preparing this is I decided to go in and compare these two different things using a tool we call the Tackle Theta spreadsheet. Now, I'd recommend strongly you learn how to use this tool. And let me change some of this stuff. 25 delta, 2320, 2330, 275 against 925. All the math that I just did and kind of just threw out there in the cosmos as I was explaining it, you can actually build those numbers in here and better understand the expectation, your return on investment potential, your cushion, where you should set an alert to know when things are getting out of hand that you need to be paying attention to, and so on and so forth. The first line here, and I'm going to highlight the whole thing all the way to that point right there. The line I just highlighted in yellow was the more aggressive trade I built first. The second line here is the more conservative trade I built second. And if you understand the conservative nature of it, there's a couple things that stand out to me. That being a lower delta number, 10, gives me a higher probability. See this buffer right here? Very important to me that I get enough cushion in my trade to feel like I can manage it comfortably, not have to get too worked up about it, and stare at it 24 hours a day. So I like the lower delta with the standard ATR buffer, and simply put, yes, I do make less money on the lower delta, but I still feel comfortable with an 8.2% standardized ROI. I still feel very comfortable with a 9.9% 36-day ROI. And I feel confident in the cushion behind it, the probability behind it. And this is the way that option trades work. Coach Matt, that is what I got today for Jedi Options.
Thank you so much. You did a wonderful job standing in for Coach Tyler, who also does a wonderful job. But really appreciate the detailed assessment of the bear call. Thank you for going through the different strike prices and, one aggressive versus one more conservative. You look at the spreadsheet, and you see two numbers, ATR buffer, and then you look at the ROI, and you're like, wow, 25% standardized ROI, 2 ATR buffer versus 8.2% standard ROI versus 4.1. Oh man, let's take this sexy. Let's go 25. Let's get it on. But then you do it a couple times and you have to make management decisions because you don't understand probability of touch. And then you understand that those management decisions have a tendency to eke into that 25% potential ROI on a monthly basis. And then you think about this from a time management perspective. That 4 ATR buffer, that might only seem like 2 standard ATRs, correct?
Mm-hmm.
That 2 to 4 ATR buffer is the difference between this market breaking out and going gangbuster bullish versus us maintaining neutrality. Does that make sense?
100% correct. Yep, that's right. It's a big difference in the implication of management, the cushion that you have, and these tools, they're there and designed to help you understand that simpler and faster on a daily basis when you have to build these trades out. So yeah, great point. Yeah. I love it. No question about it.
You know, when you're a young trader and, you know, these things aren't as important, the 25% starts really like, wow, I can go get 25% of my money. I can make a lot of money. That's fantastic. The older you get, the wiser you get a little less bold too.
That's right.
Right. And that 9.8% stands out. The forward range stands out. The conservative time management stands out. The lifestyle in the back of your head stands out. The lack of decision making you have stands out. It's the better trade.
I agree. All right. Well, a couple of things, by the way, if you're out there and you're watching, if you're a pro member, you can review our playbooks over here in Tackle Trading. Just go to the Trade Center, Tackle Trading Playbook. If you're not a pro, you can start a trial and review them as well. You know, we have content around the strategies, different techniques. What I just did was a theta strategy, and you can find more of that detail right there on Bear Call Spread. Just open it up. There's a PDF and a video. The journals that we've been highlighting, hit the Trade Center, trading journals right there, also a part of your pro membership. And in my opinion, one of the most underutilized tools for pro members out there. If you're using them, great. You already know how valuable they are. If you aren't using them, get a copy of those journals and start really digging into them. No question about that. Cash flow condors. I'll drop this link. It's a wonderful system. There's a lot of content that Tyler's put in. It's a 6-hour course, you know, teach you how to correctly trade condors and, you know, be a part of all of those different things. But I care about none of those things at this very last second as we wrap up the show. Matt, any final thoughts for the team out there? And give me that video, young man. For one specific reason, and this is going to be the way that it is.
You're terrible.
I am terrible. I know it. People have been saying it throughout the show. I know. I'm paying for this later. I am paying for this later. My big brother, the CEO of Tackle Trading, my business partner for the better part of 16 years, my best friend in the world, somebody I adore. It is his birthday today. And the older we get, they still matter, Matt. I know you and I, we don't love birthdays.
I already said the older you get, the wiser you get. I already patted myself on the back.
So I'm good. As I've gotten wiser, I'm not going to miss an opportunity on a very important day in somebody's life that I care about to say happy birthday.
Thank you very much.
You are very much appreciated by our entire community. You bring value to what we do each and every day. You're the man. You're awesome. I appreciate it.
I love our community. And I really do appreciate the birthday wishes. It is, you know, as the older you get, I haven't fully embraced the happy side of the birthday wishes. The older I get, the more I just want to kind of, you know, barrel down and get the nose down, the head down, and get to work. But I really do appreciate the birthday wishes, and to all of our community, you guys are the best. We love you guys, and we're happy to be a part of this community, and we look forward to you know, discussing and hanging out with you guys on a daily basis. So appreciate that.
You know, and last week it was Coach Tyler's birthday, and he had to schmooze the audience to try to get them to win Trade Masters that night.
You're going to win on your own.
That's exactly right. That's exactly what I was just going to say. Coach Greg, I don't need any of that. I'm coming after you tonight on Trade Masters.
That was Tim's subtle way of reminding Tackle Trading that you supported Tyler last week when he tried to do that. Yeah,
and now
so I just wanted to point that out, that he's doing the same thing. But no, let's say this is Coach Tim's first go-ahead at the Trade Masters. He's taken on a former champion and current champion based on the rules. Greg, I'm looking forward to it, and I'm certainly going to be watching it, and I hope all of Tackle Trading is there to support Coach Tim, and obviously always Coach Greg. And if Tim brings the thunder, support him. Yeah. If he brings some junk, kill him like Emily does.
Then float me 100%. It should be on merit every time, but be there and let's have some fun. I'm going to bring some analysis, bring some interesting picks, and maybe go a little bit different angle that Greg hasn't had before. So
I'm interested in seeing your picks here.
It's going to be fun. I already got some plans. I'm not sharing them yet. All right. We're done here for today.